What is a price-to-earnings ratio? Well, as the name suggests, a price-to-earnings ratio is simply the ratio of the price per share of a stock divided by the earnings per share of that same stock. And all else equal, a lower price-to-earnings ratio means you will be paying less for an asset. And this is because as the PE, or price-to-earnings ratio, is also known as the PE ratio, so as the PE ratio is going down, then the earnings per share are becoming higher in relation to the price per share of the stock. And it's easiest to understand this by thinking about the inverse of the PE ratio, so the earnings to price ratio. If you think about it that way, you can clearly see that as the earnings to price ratio goes up, then there's more earnings in relation to the price. So as the earnings to price ratio goes up, then you're making more earnings in relation to the price, and thus as the price to earnings ratio goes down, you're making more earnings in relation to the price. So you may be wondering, when people compare two companies, why wouldn't they always go for the company with the lowest price to earnings ratio? Well, this is actually because companies and industries are volatile, and some are much more volatile than others. So this is one of the reasons why people would go for a company maybe that has a higher PE ratio when they're comparing a few companies. Because the key with understanding PE ratios is all else equal, a lower price to earnings ratio means that you will be paying less for an asset. So if all else isn't equal, for example, one's more volatile, then you may go for the higher PE ratio, and it just depends. So it's just one aspect of valuing a stock in a company, and there's several things that go into it. So PE ratio is just one, and it's important to keep that in mind. So I'll just demonstrate an example of a PE ratio calculation. So let's say we have company A, and company A has a price per share of $10, and there are 100,000 shares outstanding. And we'll say that the company as a whole earned $200,000 in the last year. So we'll look at trailing earnings here, and we'll say it was $200,000 over the last 12 months. And then we would take the earnings and divide it by the number of shares. We would get $2 as the earnings per share, also known as EPS. So to calculate the price to earnings ratio, we simply take the $10, which is the price per share, and divide it by the $2, which is the earnings per share, and we end up with a price to earnings ratio of 5. And if you have any questions, please leave them in the comment section down below. Don't forget to like the video if you learned something, and subscribe to the channel for more finance-related tutorials and videos, and thank you for watching.